Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today, I want to show you how I buy my stocks. How do I decide this is the point that I want to add more to my portfolio? And as you know, if you follow me on public, you know that I add money every single Friday. I've done so almost without fail for the last 2 years as I've been on the platform. However, I'm not a true dollar cost averager on public. Now, my 401k, my IRA, that stuff is automated. So yes, whatever amount, 15% is what I put in. 15% of my salary, it goes in, you split it out by 2 weeks. That is absolutely dollar cost averaging. For those that don't know, dollar cost averaging is adding the exact same amount of money to your investments on a regular schedule, monthly, bi-weekly, weekly, whatever schedule that's going to be for you. However, I started to make a switch early in 2022 where I add the same money to the account. However, what I'm investing in is different. I used to truly dollar cost average. Let's say I took $100 and split $10 across all my stocks every single week. That's not what I do anymore. And instead, I'm using a little bit of a mixed approach where I decide based on what the chart is telling me, I'll show you that in a second, to say I'm going to go and add money to Apple and O'Reilly's. And the next week, I'll look at the chart and say, not Apple, not today, not this week anyway. Let me go for Google and Adobe based on what I'm seeing. So it's really a combination of dollar cost averaging, maybe some value averaging, and definitely what we call technical analysis, and that is looking at a chart and deciding what are your entry points. Now, because everything that I invest in on public and 97% of what I invest in for my my kids, my IRA and all that kind of stuff is long-term investment. So I believe at the time that I'm doing these videos and the time that I'm doing my research, I believe they're things I want to hold and things I want to keep around. Obviously, no one wants to buy something that's going to be terrible, right? So because in theory, this should work over the long term, assuming that those companies are good because you're getting them for a cheaper price. So enough talking, I'll show you what it looks like. So let's go ahead and go to a chart. So this one is O'Reilly's. I own O'Reilly's, one of my favorites, at least right now. And we'll kind of go over what this chart means, and then I'll show you what I do. So this is called a candlestick chart. These green lines, these green candles are when the stock was positive, when the stock went up, and then these red candles are when the stock went down. Let me get rid of this ad here. Okay, so it's bunch of bad days, a good day, and you can see even good and bad, but the stock market definitely oscillates. It goes up and down, up and down, up and down. That's how the stock market works. But what I do is I come in here really Thursday night, sometimes Friday mornings, but definitely Thursday night. And what I'm attempting to do is find these little low points. So these quote unquote dips. So I would love if I could do this perfectly every time, which I can't, is I would come in and get it when it's around, let's say about $635, $640 anytime that I could. So what I'm attempting to do is say, let me wait until the stock comes down here. Hopefully it's on Thursday night or Friday, and come down, buy it at around 640. Stock goes up, comes down, buy it around here at 638. Goes up a bit more, buys more down here at 637. And every time it comes to a certain area, it's not exactly this area every single time, but when it comes down to a certain area, that is where I want to pick it up. Now, why would you do this? The advantage of doing this on paper and in theory is that I'm lowering my cost basis. So if the stock is going to go to 713, which is what it did in this case, then do I want to get it at 708? Because from 708 to 713, that's about a $5 profit. That's not all that great. If I'm dollar cost averaging, I could have done that, right? I could have bought low and then also bought high and then bought higher and then bought low and then bought high and bought low, and really kind of thrown off what my average cost per share is. But if I'm using technical analysis, I might be able to consistently get it at a cheaper price, and over time, if the stock is good, then I would have gotten an average of, let's say, $637, and the stock goes up to 713. I'm looking a whole lot better as an investor if I'm able to understand the chart well and choose these right entry points. Now that's the risk here. You might myself included, you may misinterpret the chart and not buy at the correct points. It is easier to do this looking backwards than what it is moving forward, and I'll show you that here in a second too. So I actually went back to give you a decent look at this, but in reality, or what continued to happen, so this is, you can see down here the bottom, this is April, right? We're May going into June, and you can see that O'Reilly actually fell off after earnings right here. So then, right, so from 637 for a bit, it was all the way down to 574. Now again, the good news is if I was consistently buying around that 640, $637 or whatever it was per share, to go from 630 down to 580 is easier to stomach perhaps than going, if you look here, going all the way from 740 something and going from 740 something to 540 something. That's a bigger drop. Not everybody's able to stomach that. So again, this is going back, this is in theory, it's what I do in practice, but it's easier to stomach that assuming that you're even getting it at that 630, 640 level. Okay, so if I were looking at this right now, let's say this is on Friday, but again on Thursday night, I would go through and look at this. I would prefer to, based on how the chart is moving now, because earnings happen, so now I've really got to reset my focus. So what I would do is kind of zoom in and say, you know, where does this kind of dip and come back? Well, obviously right now that the answer is 577. So I would wait until this comes down to 577, and then if this happened to be on Thursday or Friday, I would definitely buy more of O'Reilly's at that point in time. Depends on what happens between now and then. I don't know what the chart is going to do. We never do, which is why I don't make these determinations on Wednesday or Tuesday. I wait until Thursday night and then make a decision for the next day. So that's how I would do it for something like O'Reilly. Something like Apple is very similar for the exact same reasons, in that look how Apple kind of operates here. And I drew this blue line to kind of give you a better illustration. Apple at this point, this time frame we're looking at, kind of goes up and down and up and down and up and down. So again, the advantage of doing this, if you are correct and if the stock is good and it continues to go up, is this, where I can average, let's say about let's call it 155, right? If it's going to go to 166, I'd rather get it at 155, because here, if I'm dollar cost averaging, I happen to get it, you know, decently low, but then high and then low and high and low, then my average is going to be a lot higher. The average cost I've paid for all of the shares, and my profit's not going to be as high. Let's say if I dollar cost averaged, and I'm not going to pick the exact dates, but let's say December 1, January 1, and you can see the dates at the very bottom down here. Then let's say my average is going to be higher. Let's say my average cost per share would be 161. If it's at 166, then I'm averaging a $5 profit. That's not bad, especially in this market. It's not bad, but it's not the best, right? So if I could understand the charts a bit better, I would love to look at this and get it around 158, get more around 152 or so. I would have gotten more, was this May 2nd at 156, right? And really helped myself and increased my profits by doing so. Again, it is easier to do when looking at the past than it is to do in real time, but you get the picture. The picture here is to understand what those low points are. What are those levels of support, is what they call them, and pick up as many shares as you can at that point in time. So what I do again is I deposit money in my account, the exact same amount of money I do every single week, and I go through and search through my portfolio and see which one of these do I feel is at this one of these low points, and at what point do I feel it is going to bounce back up, because sometimes you don't know that, and I'll show you this here. So let's look at, this is March 11th, right? March 11th came down and it took off, right? If you could have bought as much as you could at 150 and then sold up here, that would have been great, but again, we didn't know that. So to kind of show you that, let's do it like this. Now if I'm doing it like this, right, it looks like it's going to go down and continue going down. So it is difficult for you to say that this is the exact point that you want to buy because you think it's going to go up. It's hard to say that when looking at what you see right here. However, I do see that, you know, around this area, around 148, it did, you know, come down and start to take off and then come down again. So perhaps I would have evaluated correctly and said that was the point I wanted to buy. If I did, then it would have worked out during that particular time frame. So there is a little bit of I don't want to call it guessing, but this is that technical analysis part of it. Is it required? No. One way, and this is why I'm still a big advocate for dollar cost averaging, is because I don't have to do this, right? I don't have to sit here and guess. I can just put in the same amount of money every single week. My returns might be slightly lower. However, if it's a good company, 5-10 years from now, it's not gonna matter, right? It may not matter at all, but in the short term, it may help me a bit more. And even though the long term my returns could be a bit higher, even though the risk is a bit higher, because I could be wrong. If I am wrong about a certain level, and or when I want to buy, and the stock continues falling, well, what good was that, right? I may reduce my losses, maybe, but yeah, not always the easiest, most consistent approach in the world. And I think that is the thing too. This is more of a, I don't want to say expert level of going through this, but definitely maybe medium level, because it does take a bit of practice to understand, and then your approach to looking at these charts may be completely different than mine. And again, I don't really consider myself that big of a technical technical analysis person. So I went through the chart. I just kind of went forward in time, and you can see this is where we are as of this recording. So at this point, right, Apple has fallen off, as did most of the stock market after March. It's almost straight down. So at what point would I decide to come back and get Apple? Really depends on what the chart does between now and Friday. Obviously, I'd love to get it around 138 at this point in time, right? But it depends on what happens between now and then. So again, it is adding money to the account every single month and really picking and choosing your spots. I think of it like a boxer, where you're kind of really bobbing and weaving, really looking for that right punch. And in this case, you're looking for the right price. What formation, what point do you want the stock to drop to for you to go and say, boom, this is where I want to go ahead and add money to this particular company, and hopefully things start to bounce up and you're improving your position. And for me, it rotates. Go back and look at some of my trades on Friday. You'll see that sometimes I'll rise, sometimes Target, sometimes Capital One. It really depends. And the reason it depends is because what I am personally looking at on the chart the night before. So it costs a little bit more effort. It's a little tougher to do and gauge correctly on a consistent basis. Those are the downsides. I'll see how it performs. Some days it looks real good. Other days it doesn't. If you remember the video I did about Target and how adding money to the account can be, or adding money to your investments at the right points can be a bit better. You saw how if I invested a lump sum of Target compared to what I was doing and really gauging when to get into Target, I had performed a little bit better than where the market was, or a little bit better than what Target was doing as a whole if you had put in a lump sum. The problem though is I was looking slightly better than everybody else up until Target announced earnings, and it fell 25% a day. So there's that, right? That's a part of 2022. So again, just a little background of how I do it. You don't have to. I honestly would not recommend it unless you have that type of risk tolerance, because this is something I'm just kind of learning and doing on my own. It doesn't have the exact same research and backing as dollar cost averaging. The good thing here is a company like Apple, I think we're all pretty solid that Apple's going to be in business. So I think investing in Apple in any capacity is probably going to be a good thing for you. But this is just how I go through for my own personal investments. I want to show you what I do. All right. So if you have any other questions or things that you want me to cover, remember, this is y'all channel. So usually, if you have good questions and comments, I'll probably make a video about it. So that's up to y'all. Let me know what you think in the comments. All right, that's it for me. Talk to you later.